Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews. And this is our weekly currencies report here with Dan Bell from HiFX. Dan, another amazing week in the world of currencies, so many big events, starting of course with the Federal Open Market Committee's meeting this week and the press conference, the first we've ever seen from Federal Reserve Chairman Ben Bernanke. What came out of the meeting and the press conference that stood out for you?
Indeed, yeah, another interesting week in the world of currencies, as it tends to be lately. The FOMC announcement sort of came and sort of went with not a lot of reaction really. I suppose the market was expecting something a little bit more from the press conference. It was the first media briefing that the chairman's given ever. But I think he was quite careful to be quite measured, sticking to the recent script there, which is interest rates to stay lower for an extended period, and for the quantitative easing to finish in June. So effectively, the market's taken that as a reason to buy back into risky assets. Interest rates in the US at 0 to 0.25% are still very accommodative. And the expectation is we're not going to see any change there probably until the first quarter of 2012. So,
wow, that is an extended period and extremely low. I mean, 0%. What impact is that having in global capital flows, carry trades? What's the effect there?
Well, I mean, you could argue because the US equity markets have done quite well recently. We're getting through the first quarter earnings season in the US at the moment. 75% of companies that have reported so far have beat expectations. So essentially, we're seeing a sell-off in the US dollar, but I don't think it necessarily reflects the market dumping the US as such. Obviously, there's concerns with their fiscal position and the rest of it, but I think if the market was dumping the US, they would also be dumping the US equity market, and we're not seeing that. The US equity market is performing quite strongly, but at the same time, as far as the interest rate differentials within the currency markets, clearly the lower interest rates in the US are favouring higher yielding currencies, and currencies that are supported by central banks that are focused on price stability, like the ECB and the RBA.
And we've seen the New Zealand and Australian dollars quite firm this week. The Australian dollar almost getting to $1.10 US. That is something, isn't it?
Absolutely phenomenal. We got up to a high yesterday in the Aussie to US at 109.48. So just almost up at that 110 mark, which we sort of talked about last week. And I think a lot of traders are looking at that 110 mark and sort of like a target, so to speak. So we're seeing quite a lot of sort of positive momentum still in the Australian dollar against the US, and it's going to be a big week for Australia next week as well, with the RBA announcement on Tuesday.
On that issue of Australian interest rates, they're higher than ours here, and it looks like they'll go up before ours will go up. Is that right?
Correct, yeah. So the RBA, the current cash rate in Australia is 4.75%. We had an inflation number out of Australia this week. The CPI data came out at 1.6% for the quarter and at 3.3% for the year. Now 3.3% is above the Reserve Bank's target band. So we're starting to look at that and say, okay, there are some price pressures from the floods in Queensland, etc., flowing through to food prices, but other measures of inflation across the board are up. So you'd have to expect that the Reserve Bank of Australia are going to have to raise interest rates within the next few months. And that's obviously at odds with our central bank, who on Thursday were reasonably dovish and weren't really indicating that our rates were going up anytime soon.
Now, this different outlook for interest rates on both sides of the Tasman is having an impact on the New Zealand dollar versus the Australian dollar. What are you seeing there?
Yeah, absolutely. The New Zealand dollar dropped down to a low of around 72.40 following the Christchurch earthquake, but subsequently recovered back towards 75.70 last week or so. In the last couple of days following the higher CPI out of Australia and the more dovish RBNZ yesterday, we've seen the New Zealand dollar trade back towards 73.50. It has traded a little bit lower than that, and our expectations are that it is going to go lower. So 72.40 was a 20-year low in the Kiwi-Aussie exchange rate. Obviously a great time for our exporters into Australia, who are taking advantage of those 20-year lows. And our thinking is if the RBA continues to raise interest rates and we stay at these current levels, we could see the Kiwi-Aussie rate, potentially get down to 70 cents.
Wow, that would be amazing for the ski season this year down south with all those Australians coming across.
Absolutely. I'm sure we're going to see a flood of Aussies coming over for the ski season, and no doubt they'll be looking at some of those Queenstown houses and potentially thinking about maybe buying a second or a third home in Queenstown.
Those rich Australians. Now, across the other side of the planet, Britain, the economy is really struggling, and this wedding isn't going to help it much, but what's happening in the cross rate between the British pound and the New Zealand dollar?
So the New Zealand dollar has been reasonably strong against the pound recently. We pushed up to a high of around 49p recently. The Kiwi pound got up to just around 50p around January this year, but following the Christchurch earthquake we got down to around 0.44. So, in light of what's happening in the UK economy is very patchy. I don't think anyone would disagree with that, but their interest rates are currently set at 0.5%, so the Bank of England have got rates very, very low. And I think, despite a patchy economy, I think they are going to have to start looking at raising rates this year sometime. And I think they're a little bit behind the eight ball, so potentially, even though, I'm not a huge fan of the UK economy at the moment, I believe that, higher interest rates in the pound sterling will ultimately attract more flows, and potentially the Kiwi pound would come under some more pressure.
So looking ahead to next week, some big news coming out of the US.
Yeah, so out of the US we have the non-farm payrolls data, which is released on Friday. The markets always watch that number very closely because it's quite a good reflection of their economy. It's the employment figures for the previous month, so effectively it's the employment change and unemployment rate for the month of April. And the market is expecting unemployment rate to come in around about 8.8% and employment growth somewhere around about 200,000 new jobs, which wouldn't be a bad outcome really. So yeah, we'll be watching that to see what happens, but it can be a reasonably volatile series as well.
And jobs figures in New Zealand too? Yes,
that's right. Jobs figures released in New Zealand on Thursday. The market consensus there is unemployment to come in at around 6.6%, which will be an improvement on the last quarter, which was at 6.8%. And again, a pretty volatile series. We have seen some pretty big swings in the labour force data that gets released from Statistics New Zealand, so it's kind of hard to read too much into it, but I think we are seeing a bit of an improvement there.
Fantastic. Dan Bell there from HiFX with our weekly currencies report. I'm Bernard Hickey for interest.co.nz.